We are going to continue the lesson 5. Last time we just discussed about certain concepts on bonds and other instruments, fixed income instruments. So in the last lesson, we discussed about the bond valuation process, then the face value, market value, yield to maturity, and discounted value of a bond, coupon payments of a bond and zero coupon bonds, then the dirty value, clean value, and accrued interest of a bond. So the last part, we just browsed through, but we didn't have a comprehensive discussion on those things. So therefore, I will continue with that. I think we started duration of a bond as a measure of sensitivity, interest rate sensitivity. It's a measure that we try to establish. It gives an understanding about the sensitivity of a bond. Sensitivity in the sense, now we discuss about the yield and price relationship of bonds. When the market interest rate changes, the bond value changes. Now, when we talk in terms of a bond value, it is in rupee or dollar terms. Face value, we call it face value, or the market value. Face value doesn't change, but market value changes according to the market interest rate. So therefore, the price of a bond is a function, or is really depends on the market interest rates. Now, when you say market interest rates, we call it the yield to maturity. Now, when you talk about bonds, we realize that there are basically two types of bonds. One bond type is coupon bonds. The other one is zero coupon bonds. Now, we understood that zero coupon is a bond which doesn't pay any coupon interest during its tenure. The price of a zero coupon bond is determined through the market rates or yield to maturity. So there we can understand there's a relationship between yield and the price. Now this relationship is an inverse relationship, why we call it inverse, because when the price increases, or when the yield increases, the price decreases. Or when the yield decreases, price increases. So that is the relationship, price and yield relationship. Now when you plot the price and yield relationship as a graph, you get a curve. I can show that in the presentation. Right, this one. Under this presentation, we can just check the right. Now you see the slide on your screen. You can see the x-axis as yield, y-axis as price. So this is yield versus price. So price versus yield. Now here normally what we take as independent variable is the x-axis. The variable which is in the x-axis we consider as the independent variable. The y-axis is taken as the dependent variable. Now when you assume yields, you can get the corresponding price. Now you just check when yield is this amount. I put the arrow there. When the yield is that amount, the price will be this. So the value of the particular amount, price amount is this. When the yield increases by this amount, the new yield is this. So I put the arrow there. The arrow points the level of yield. Then the corresponding price will be this. So to get that value, you have to draw a line parallel to the x-axis and it meets y-axis here. So that is the price. Now you observe that earlier price was this when the yield was this much, but now the price is this. So that means the price drops with the increase of yield. So that is the relationship. The duration measure is a certain measure where we can get an understanding, get a certain type of sense of yield and price relationship. Yield and price relationship. But there are several assumptions here. Several assumptions. Now, with all these assumptions, we have come to a certain relationship. And that relationship, last time we discussed. Yeah. Yes, any question? Now I can just show you the relationship here. Price difference is given by this much. Now when you say delta P over P, delta P is the price change, P is the price. In other words, you can put it in cross multiplication, delta P is equal to minus D into delta Y into P. So this relationship we obtain through that curve. But we had several assumptions here. The assumption is we assumed this portion as a straight line. But even though it's an assumption, it's an assumption really. There's no reality here. So then it's a curve type of a thing. But it becomes a straight line when the yield difference is very small. So therefore, the duration measure is not give any valid. So you can say the duration measure is reliable only for small interest rate changes. It is not reliable for very broad interest rate changes. Now I can give an example. Now you normally measure interest rates in basis points. Say for example, if the interest rate change is higher than 150 basis points, in normal terms we call it 1.5%. 150 basis points is equal to 1.5%. If the interest rate change is higher than 1.5 basis points, the duration sensitivity measure is not that reliable. So the reliability of duration measure depends on the level of interest rate change. So therefore, we have to make an adjustment to this duration measure or the calculation of sensitivity through some other means. In the situation where the interest rate change is higher than 150 basis points, duration measure alone cannot give a reliable answer. So therefore, we have to incorporate another adjustment to that. Now that adjustment is known as convexity adjustment. Convexity adjustment. With the convexity adjustment only, the reliability of sensitivity measure would be okay. Otherwise, if you just use the duration and calculate the changes of price, that would not give reliable results. I think you make it a point that what I want to tell you is this duration measure is reliable only when the yield changes are small. Small in the sense, I think we can, there's no hard and fast rule to say that small is less than 150, but in reality or in practice, we assume if a yield change is less than 150 basis points, then we can consider it as a small yield change. So if a yield change is higher than 150 basis points, then we need to use the convexity adjustment for these sensitivity calculations. That is the principle I want to just convey to you. Then we have already done the duration measure, and that duration measure we can establish, or we can determine the duration measure by using a certain methodology. And I just explained that method last time. There are also, we have two basic methods to arrive at the duration. What do you mean by two basic methods? Now, one is the interest is compounded half yearly or quarterly or something like that. But if the interest is compounded continuously, then the method would be different. The calculation would be different. That's what we last time observed. Duration calculation can be done through normal compounding. That is half yearly or quarterly or monthly or whatever it is. That compounding is also possible. But it is not continuous compounding. If it is continuous compounding, then we have to follow another methodology to calculate it. Now, in the presentation, we discussed about calculation of duration considering continuous compounding. Now, what I feel is now you all realize what is continuous compounding. I told you that day when interest is paid for an instrument of 1 year, if the interest rate is paid monthly. So in order to calculate the effective annual interest, you need to compound the interest monthly for 1 year. So then you will get interest cash flows 12 times during the year. If it is paid quarterly, you will get 4 interest payments during the tenure. Then it can be compounded 4 times. And at the same time, if you have half yearly, then there will be 2 times compounding per annum. And I told you this compounding can be reduced. I mean, reduced in the sense the times can be increased by increasing the times of interest payments during a year. Say, if it is paid daily, there will be 365 times compounding. If it is paid hourly, it will be 365 into 24 times compounding. If it is paid per minute, then it should be 365 into 24 into 60. If it is paid per second, then it would be 365 into 24 into 60 into 60. Now, likewise, you can see when the timing, how long would it take to compound, is becoming smaller and smaller, the times of compounding would be very much higher. It becomes very much higher. Now you can imagine if the time of compounding is a fraction of a second, in no time it is being compounded, that means the times of compounding would be very much higher. Now we call it infinity. Now if you have infinite times compounded a certain interest, that we call continuous compounding. That we call continuous compounding. Now this is the theoretical background for these things. Now I need to get your feedback whether you have understood these things. Then we follow all the mathematical methodologies to calculate these things under these principles. Now you can see this calculation worksheet. In that worksheet, we have taken time as time in years, and it is the interest being paid every half year, and since it is compounded continuously, we calculated the cash flows and the present values, using the continuous compounding method. I think we discussed these things last time also. With that, we just had this worksheet, and all the present values you can see. The total of these present values will give the price of the bond. And when you say weight, the weight means the present value, what is the portion of the present value with the price. So in other words, you can arrive at the weight by dividing 4.709 by 94.213. So you need get 0.05. Then next weight would be 0.047. And when you add it up, you get 1 as the answer. If you don't get 1 as the answer, then you might have made a mistake. But if you get the answer as 1, then you are okay with your calculations. But there can be some type of small difference here in 001 or something like that. So that really you can attribute that to the rounding of things. So since of this rounding off only, you can make a mistake. Otherwise, you are wrong if you don't get 1 here. Now this is the most important column in this worksheet. What you need to do, you need to multiply the time with weight. Then you get time into weight. That column you need to total up. That total gives you the duration. Is the duration of the bond of this nature. 3-year 10% coupon bond with a face value of $100. And yield of the bond is 12%. So that bond's duration is given by this worksheet. It is 2.653. The duration is measured by years, 2.653 years. Now here, the calculation was made using the continuous compounding method. In international financial markets, very frequently the calculations are made on the basis of continuous compounding. But in Sri Lankan markets, I have not seen that continuous compounding. They try to do it through the normal compounding, not the continuous compounding. And the other thing what you need to understand is I just conveyed something with regard to a particular bond which is purchased in between or in the middle of a coupon period. In the middle or within the coupon period. Now, if it is purchased on a coupon date only, you can calculate the price without that much of an issue. But if you purchase it within the coupon period, so then there will be some accrued interest to be taken into consideration, and the calculation method is also different. So that also we discussed. So those are things we discussed earlier time. Anyway, now today what I want to tell you is, now we are trying to apply these measures into the analytical calculations. Now, as it is, I want to give you another type of adjustment. As I told you earlier, there would be an adjustment if the interest rate change is higher than 1.5%. So now I am referring to that adjustment now. The adjustment is actually, there's another measure called duration, convexity comes. Now, convexity really means, I can show you geometrically that one. Right. Now you can see the curvature here. Now the convexity is a measure of this curvature. Now if the convexity is low, or I can show you that in physical terms. Now you can see some curved nature, or we call it curvature of this graph. That's a curvature. Now you can have a sharp curvature curves. Now this curvature is not very sharp. If the curvature is very sharp, highly curved, then we call it high convexity. Now if the curvature is not that sharp, we call it low convexity. On the other hand, this low convexity is approximated to a straight line. So now this concept, I think you need to understand. Now when the convexity is high, the adjustment is a must. When the convexity is high. So therefore, you can just have a test with regard to the necessity of convexity adjustment. The convexity adjustment is necessary for a particular price yield relationship which depicts a curved, highly curved relationship or sharp curved relationship. So it is a must. Now I will tell you how we can calculate convexity. Now, last time we calculated the duration of the bond and we got it as 2.653. In order to calculate the duration of the same bond, convexity of the same bond, what we need to do is, we need to square the time column. You need to square the time column. We call it time squared column. Time squared column. Okay. Now, if you just look into this, modified duration may not predict the rate sensitivity in a reliable manner for higher level of interest rate variations. That's what I just explained. Duration measure assume the relationship between price and yield as linear, as the relevant interest rate changes are minimum. Now, this is the principle I now try to convince you. And if this is not linear, the curved nature is so much, then we cannot rely on duration. When a substantial change in interest rate is present, the curvature of the price yield curve matters. Then the price change should have the convexity adjustment. Convexity is the time squared weighted present value of expected cash flows of a bond. In order to arrive at more reliable projections, convexity adjustments also to be included. Now, this is the principle I have now conveyed to you. Anyway, now I will just show you how we will arrive at convexity. Now, as an exercise, you can do it. Right. Now, you just refer this. And you can have this time squared column somewhere here. Somewhere here. You can have in your notebook or whatever. You can have your time squared column. Now, what is time squared column? Now, say I can just give you some guidance now. 0.5. 0.5 when you square it would be 0.25. 1. If you square it is still 1. 1.5 squared is 2.25. 2 squared is 4. 2.5 squared is 6.25. Likewise, 3 squared is 9. Now then you put the values here. You put the values here. Then you have another column, time squared into weight column. Time squared into weight column. So can you add that column here? Today what we are going to do is we are trying to measure the convexity of this bond. Yes. Okay. Now I am just asking you whether you got it. Now I just mentioned you why we need to go for convexity. Now when the interest rate changes are higher, the duration measure is not adequate to determine the price changes through duration, but we have to make use of convexity also. Right. Now what I want to do is you can just go into that column, right? You can just go into that column and you have to add the time squared column to that. Time squared column. Now there are weights given, no? And time is given. What do you mean by time squared is you need to do time squared column, you have to add it. When you add the time squared column, you get these values. The first value would be 0.025. Right. Then the second one would be 1. 1 squared is 1. 1.5 squared is 2.25. 2 squared is 4. 2.5 squared is 6.25. 3 squared is 9. Now you get the time squared column. And what you need to do is you need to have another column constructed, and we call it time squared into weight column. Time squared into weight column. Now, how do you get it? Now, what you need to do is you need to multiply the time squared column with weight column. So that is 0.05 into 0.25. That is the first value in the time squared weight column. Right? Now, can you do that as an exercise? Yes. Now you add that column into the last column. So what you need to do is you need to have time squared column first. In the time squared column, shall I put it on the board? I just put the time squared only. So then you need to have another column, that is time squared into weight column. So in that column, the result should be you have to get the time squared value and it has to be multiplied with the weight. So therefore the first value should be 0.05 into 0.25. 0.05 into 0.25. That comes to 0.0125. 0.0125. Right? Then the second value, that comes to 0.047 into 1. Or 1 into 0.047, that is 0.047. Then the next one, the weight is 0.044, time squared is 2.25. So then 0.044 into 2.25. 0.044 into 2.25. And you get the value 0.099. Then you get another value 0.042 into 4. 0.042 into 4. That is 0.168. Then you get the other one 0.039 into 6.25. That is 0.24375. The last one, that is 0.778 into 9. 0.778 into 9. That is 7.002. Now you can just look at it again. Now I will just repeat what I said earlier. Now we went to the calculation of duration worksheet, and in that worksheet the last column is time into weight column. Time into weight column. Now in order to calculate the convexity, we have to add another column there. That column is called time squared column. Now when you add the time squared column, the values should be these things. Time squared means you get the time and it has to be squared. Now the first line of time is 0.5. When you square it, you get 0.25. Then you get a time value as 1. When you square it, it is 1. Then you have another time value 1.5. When you square it, it is 2.25. Then you get time 2. When you square it, it is 4. when you have 2.5 as the time, when you square it, it is 6.25. And when the time value is 3, when it is squared, it is 9. Right? Now you get the time squared column as it is. Then the final part is you need to have time squared into weight column. Time squared into weight column. What are you going to do there? Now there you have to multiply the weight with the time squared. Multiply the weight with the time squared. So weight is 0.05 for the first one, and the time squared is 0.25. So therefore, the answer we can get through 0.05 into 0.25, that is 0.0125. Next one is 0.047 into 1, that is 0.047. Then you get 0.044 into 2.25, that comes as 0.099. So likewise, you get all these values. And when these values are added up, that value is called the convexity of that. I think you got my point. Are you okay with that? Are you okay? Yes, I want to get your feedback. Now, today my initial requirement is to show you how to get the convexity calculator. And I just told you what is the real purpose of getting convexity also. The convexity calculation is a necessity. Right. So, any one of you just got the total value of the time squared into weight column? Yes. Can you just do that? Right. Now, when you get the, 7.57225, yeah. Yes, your answer is correct. Easily. Yeah. Your answer is correct, 7.57225. So that is the convexity of this bond, 7.57225. I think others also can follow it. Others also can follow it. Now we have calculated a very important measure of this bond, the convexity, because we will be more accurate with this convexity measure. That's what I want to tell you. Now I will show you how we can do the necessary adjustments in the calculations. Now, first of all, our necessity to have duration first. It is a measure of interest rate sensitivity. So, if the interest rate is changed by a certain amount, with the duration measure, we are in a position to calculate the price change due to that interest rate change. So, I gave you a certain relationship in order to calculate that. At the same time, now I told you when interest rate changes are higher than 1.5%, the duration measure is inadequate to get the price changes. Therefore, we need to make the convexity adjustment also. Now, I will show you what do you mean by this convexity adjustment, right? Now we'll now go to the presentation. Right. Now, somewhere here these values should come. So as per that, those values, convexity is 7.57225. So the next thing would be, now this is the one which we use to calculate the price change due to interest rate change using the duration only, right? But for higher interest rate changes, this is not valid. Now convexity, now today we discuss about convexity. Now this is the adjustments for convexity. Now we are trying to see how we are going to adjust it. Now this is the equation for the adjustment. Now you can just see, I just explained the different symbols here. Delta P divided by P, that is the percentage price change. Or we can do it in a cross multiplication. Now what you can do is, rather than put in P here, delta P is equal to minus D into delta Y into P plus half into C into delta Y squared into P. So that is the way it can be done. Now here the delta P is the price change. Delta P is the price change. Right, okay. Now we got to know these values. D we have already calculated, that is duration. C is also calculated, that is 7.57225. And we have got the value of P also. Now what I ask you to do is, I will go to the board and show you. Right. What I want to tell you is, convexity. Now you have a delta P over P is equal to minus B into delta Y plus half C into delta Y squared. Now I think this is on the slide. This relationship is on the slide. I can make it this way. Delta P is equal to minus D into delta Y into P plus half into C into delta Y squared into P. Now is delta P. Delta P is the price change. Delta P is the price change. Price change due to a change in interest rate. Delta Y represents change in the yield or change in the interest rate. Now I told you, if the interest rate change is substantial, then we are not in a position to just use duration and calculate it. But for small interest rate changes, without using this, only you can use this. Delta P is equal to minus P into delta Y into P. Now this particular thing we just used last time. Now what is the issue here? We can't use this now when the interest rate change is higher, when it is substantial. You are not in a position to use this particular relationship to calculate the price change. If you calculate the price change for a very high interest rate change, you need to use this. There you have to incorporate C also. C is the convexity. Right. Now we have been able to calculate the 2.653. C also we calculated 7.57225. Right. Now what I ask you to do is, now actually the price is also there. Price we know. E is as per our calculations 94.213. 94.213. Now what I am asking is, you have to arrive at the price change. You have to arrive at the price change. Determine the price change of the bond when interest rates increase by 3%. Now using this relationship, you should be in a position to calculate that. Can you try to do it? Now this is not a, it is a very straightforward thing. Since you have this formula, and you have the values also, that day, last week we calculated the duration of this bond as 2.653, and we calculated now today the convexity as 7.5722, and P, the price, that also we have already calculated, that is 94.213. Now what you need to do is, you have to determine the price change of the bond when interest rates increase by 3%. Increase by 3%. Try to do it. So the relationship is here, even it is on the slide. Just try it. Yes. So you also have to involve in these things, then only you can learn it. And even if you go into a book, the book really doesn't explain these things in that manner, because I have gone through several books, but I found those books really they don't really explain it well. They just say several things, and I think the readers might get confused. So therefore, this type of a thing would be very much useful for this, useful for you, because you can practically do it, and Just apply these things and see the accuracy. Can you do that now? Now my question is, determine the price change of the bond when interest rates increase by 3%. Increased by 3%. So you have to just put the values to the relationship and calculate delta P. That is what you need to do. Now we have already calculated the convexity, and last week we calculated duration. Now I ask you to calculate the price change when there's an interest rate change of 3%, or interest rate increase of 3%. Minus 6.9230. There's a small difference. I don't know. I did the wrong thing. No, anyway. I will check it again. Minus. I got two different answers, but anyway, I will check that. Others also can try. I saw 3 different answers, but if you have done it correct, you should get same answer. Anyway, right. I think Soumya Jayasekara's answer is correct. Minus 7.177. That is the correct answer. I think others can check it again. Or even I can just do it on the board. So it's like this. I will show you what you have to do. Now first thing is you can get minus d into delta y. Minus d into delta y into p. Or what we can do is without p we can do the calculations, and then it has to be multiplied with p at last. So that is also another way of doing it, right? So what we can do is we just do the calculations and multiply it with p. So for that calculation we have to have minus d into delta y. Minus d is minus 2.653 into delta y. Delta y is 3%. 3% is taken as 0.03. then you get the answer as minus 07959. Then you have to put plus half. Half is 0.5 into C. C is the convexity, that is 7.57225 into delta y squared. When you say delta y squared, what is that? Delta y is 0.03. Delta y squared is how much? 0.0009. Right? Now this gives you the answer as minus 0.076182487. But when if you want to get the price change, you have to multiply this with the price. Price is 94.213. So you get the answer as minus 7.17738. Anyway, up to the 3 decimals, that will be okay. So then we can accept the answer as minus 7.177. So that is the price change. So then can you say what is the new price? New price is 94.213 minus 7.177. So just get the new price also. The new price will be 94.213 minus 7.177. The new price is 87.036. New price. $87.036. That is a new price. Now you can see the bonds value has come down from 94.213 to 87.036. So that's a drastic drop. Why we say that? Drastic. Now this is only $100 bond, but the bonds are normally in millions or billions sometimes. So then it would be a 7 billion or something like that if it is in billions. So you can see the drop in price. So this is the reality. Now what I want to ask you is, without the convexity adjustment, if you do the calculations, then you just get it what it is. What is the price change? So that's very simple. No, you need to do the price change without incorporating the convexity. Just get the duration type of thing, then you can compare the difference of answer. Right? If you just do it without putting the convexity into that, then the answer will be minus d into delta y into p. So we will see that. What is that answer? So minus d is 2.653 into delta y is 0.03 into 94.213. That is minus 7.498. Right, you can see the answer comes as 86.714. 86.714. Now you just check. Now what I ask you to do is, without using the convexity adjustment, just do it only with the duration. Then if you do that, you will get the price change as 7 point something, but your final answer is the bonds value would be 86.714. 86.714. Now you can compare the both answers. With the convexity adjustment, you get the answer. The new price as 87.036, whereas without the convexity adjustment, you get 86.714. Now there's a big difference here. Big difference. Not a decimal difference, big difference, because this is 86 point something, 87 point something. So therefore you can see the difference. You can see the difference. What I feel is, now if you just do these things, then you get the sense, and you will be in a position to realistically apply these things. Realistically apply these things. Now I want to tell you here that there's a big possibility of having a question of this nature in your question paper, right? And make sure that you would be thorough with this. And in order to get that competency, you have to just do some exercises and try on your own. Not only that, you need to apply these things into your normal practical things. Now, as I told you, now this is a very good concept. The concept is very, very, very valuable, and very valuable in your analysis. When you do some bond portfolio management, yeah, you will see our portfolio value comes down, how it comes down and all that. So, but there are situations now, you can see for the last couple of months, the interest rates been becoming lower and lower. Now, what is the result for a bond portfolio? Bond portfolio increases, value increases, and the banks can really record the book profit. So that is there. But the traders, bond traders, will have a good time with the interest rates coming down. Right. What I feel now is now we have done the most important concept on these bond valuations and bond price sensitivity and all that. Those things will give you a certain support in your analytical work. Now we will go into another concept called portfolio duration. That is a simple concept, but anyway, when you say portfolio duration, what does that mean? Now, when you say portfolio, it might consist of several bonds, 10, 15, 25, 100 or whatever. So there's a big number of bonds in the portfolio in normal circumstances. I mean, to be simple, what we need to do is we can really assume a bond portfolio with say 4 bonds. I will put it on the board. And we have the market values of those bonds. And there durations of each of those bonds. If you have those values, we are in a position to calculate the portfolio duration. I will show it. Now you can see there are 4 bonds in the portfolio, A, B, C, and D. I have given the market values and durations of each bond. A bond market value is 1 million, duration is 1.5. The bond B market value is 3 million, duration is 2.3. Bond C market value is 2 million, duration is 1.8. Bond D market value is 5 million, duration is 1. Now what you need to do is you need to calculate the weighted duration of the portfolio. Now this is the portfolio, and required to calculate portfolio duration. Required to calculate portfolio duration. Now what is the methodology you can use? Simple thing. You have the market values, you have the durations. Now your task is to calculate the portfolio duration. Simple thing, what you can do. 1 into 1.5 plus 3 into 2.3 plus 2 into 1.8 plus 5 into 1 divided by 1 plus 3 plus 2 plus 5. 7, 10, 11. You have to divide it by 11. Then you get the portfolio duration of this portfolio. Consists of A, B, C, and D bonds. Can you do that? Simple thing. Because I just want to get you involved in these things. Then only you can lively participate. That is my necessity. So it will give you a certain power or certain motivation to do these things. And your answers coming in the screen and all that. So then you can satisfy yourself. Yes, do it and give me the answer, the portfolio duration. Jeepan, No, can you check it again? Yes, 1.545 is correct. That's correct. Yes, good. Madhushani, yes, your answer is correct. Even yeah, all are correct. Right, good. And that is the portfolio duration. Now, if you have convexity also calculated in this way, the convexity also can be really get. We can get the portfolio convexity also in that case. Uh, Now, this is a simple exercise actually when you say portfolio duration or portfolio convexity. But for that, you need to get the individual bonds durations and individual bonds convexities. Otherwise, you can't do that. Now, if you take a portfolio into consideration, it is difficult for you to get all these calculations for each and every bond. What we need to do is we can calculate the each and every bond's convexity or duration. Then you take the portfolio as a whole and you can apply the portfolio duration and portfolio convexity to that and take it as one bond or whatever. So that is the nature of these things. So then we can do it. Right. Okay. Now, I am happy that I think many people have done this and got the correct answer. And in the same way, you would have done that earlier questions also. So don't worry that if you, even though you get a wrong answer, it doesn't matter because you did a great thing because you really did a try. So that's the only thing I need. Either it is correct or not, you did some value addition. So don't worry about your answer whether it is correct or wrong. Doesn't matter. Right. Good. Right. Now I have come to a certain stage where we can talk on portfolio strategies. Now, when I say portfolio strategies, I will go to the presentation again. Right. Now, this is the theoretical background for what we did now. Portfolio duration. A portfolio consists of several bonds, can represent a single figure for duration. It is referred to as weighted duration. It is the value weighted average of all individual bond durations in the portfolio. That is what we did now. Even the convexity has the same meaning, value weighted average of all individual bond convexities. Nothing difficult here. By using the above measures, interest rate exposure on a portfolio can be determined. Now, what do you mean by interest rate exposure? Now, if you have a portfolio, now say as a manager, you need to manage portfolios in your organization. Say, for example, you are the manager for fixed income securities. Then it is under your management it comes. And you have to just represent in the investment committee or asset liability management committee or somewhere. There you have to put forward the nature of your bond portfolio, duration or convexity of your bond portfolio. So that gives an understanding about the portfolio's exposure into the interest rates. Now, for example, if you have 3 portfolios and one portfolio's portfolio duration is only 1, second portfolio's portfolio duration is only 1.5, whereas the third portfolio's duration is 6. Now, it's a rather difficult task. When you have a duration of 6 to a certain portfolio, that means it will have a high exposure to the interest rate variations. Because if interest rate variation happens, there will be a big price drop in your in that particular portfolio. So that price drop reflected as a loss. Now, as a manager who manage the portfolio, you have to be careful and you have to just take steps to bring down the portfolio duration to a rather reasonable level. So these are the things which we need to consider when you deal with this type of fixed income securities. Right. There are 2 strategies in terms of this portfolio management. Now, say, for example, if you have a particular portfolio, if it is a mix of long and short-term maturities, say, now sometimes you can maintain a portfolio with very long maturity bonds, 10-year, 12-year, 15-year, so and so forth. Long term, all are long term. Now, if you have all long-term maturities in your portfolio, what is the meaning of that? The duration, the weighted duration of the portfolio is high. When the weighted duration of the portfolio is high, what reflects that? It will be a high exposure for interest rates, because if there's an interest rate change in the market, interest rate increase basically, the bond value will come down drastically. So that is the reason you have to control, or you have to bring down the duration of a portfolio. That is why this under this barbell strategy, there will be a mix of long and short-term maturities in the portfolio in order to bring down the portfolio duration. Now, I showed you the way of getting the weighted duration of a portfolio. Now, say, when you have a mix of long and short-term maturities, then invariably your weighted duration of the portfolio would come down to a medium level. So that gives you some control. Now, in different organizations, different portfolio managers follow different strategies. Now, that depends on the portfolio manager's attitude or portfolio manager's task. Now, there's another strategy called bullet strategy. Now, in the bullet strategy, what you do is you have bonds with intermediate maturities. So that means medium term maturities, 3-year, 2-year, like. But basically, there are some hard and fast rule to say that if bond maturity is more than 5 years, we take it as longer term. But in most cases, bonds are basically long term. No? Therefore, want to be categorized as long term, it should be longer than 10 years. But intermediate means between 5 and 10, like, or even medium term, we can call it. But intermediate means less than 5 years, but more than 2 years or so. So these are the general type of attitudes in the market, but that doesn't mean that there's a rule on that. There's no rule as such. But you can just look at these things, because these things you need to just understand these things, because if you go through the literature on fixed income securities, you might come across this type of words, and then you understand what it is. Now we come to a very, you say, very important type of a concept. We call it portfolio immunization. Now, I think you heard about this word earlier, immunization. With COVID and all sort of things, immunization is a very important type of thing, because you become immune to certain things with the immunization. Now that is human type part of thing. But portfolio immunization means portfolio can be immunized on what? On interest rate. Now, if you consider interest rate variation as a disease or virus, portfolio immunization is, when you do that immunization, it may not sensitive to the interest rate variations. May not be sensitive to the interest rate variations. If you do immunization, portfolio immunization. Basically, the real meaning is, now there you need to get an understanding about these long and short positions. Now, for example, what is a long position and what is a short position? Now, long position is, now you have those things in your hand as an investment line. But when you have liabilities, deposits or whatever, or loans, it's a short type of thing. It's a short position, actually. So if you purchase a bond, what is that? It's a long position. If you sell a bond, it's a short position, right? So in other words, I think it is better if you can go by asset liability position type. If you own an asset, that is considered as a loan position. If you have a liability, then we consider it as a short position. So when you have a portfolio with long and short positions, then if you can maintain that portfolio, now we can have positive for long positions and negative for short positions, then the total becomes zero. If the total becomes zero, such portfolios are known as immunized portfolios. And there's another concept discussed here. Yield curve, a small parallel shift in the yield curve. This is also a very important point to note. The issue is, now, this is, if you are in front of me, then it is very easy for me to explain these things. But anyway, I will try to explain these things on the board. This parallel interest rate, parallel yield curve shift or whatever. Right. Now, first of all, you need to understand what is an yield curve. Yield curve. Yield curve is a curve where you get different yields for different maturities. And if you connect all these points, and that points connect. After connecting the points, you will get a curve. That curve is known as yield curve. Anyway, I will show you an yield curve. Right. Now in the yield curve, yield goes to the y-axis, time or maturity time or maturity period. Goes to the x-axis. Now you can say 1 month, 2 months, 3 months, 6 months, 12 months, then 2 years. Likewise, you can have different maturities. And for these different maturities, you might have different yields. Basically, when the maturity goes up, yield also goes up. Now, when you connect all these points, we call it an yield curve. This is the yield curve. Now, when there's a change in the interest rate, say interest rate increase, when the increase happens, the increase depends on the maturity period, tenor or whatever, maturity period. But we assume in certain instances, all maturities will be increased by certain percentage. That is an assumption. So such assumption is called parallel yield curve shift. Parallel yield curve shift. Now say for example, in the 1 month category, there will be an increase of this nature. In the second month category also, 2 month category, same. 3 months also same. Now if you have a same interest rate change everywhere for any maturities, now such increase we call parallel yield curve shift. Now I put on dotted lines the yield curve after the increase of interest rates, but all the rates in every maturity being increased by the same amount. So therefore, it is a parallel shift. We call it parallel upward shift of yield curve. Parallel upward shift of yield curve. If the interest rates go down by a certain amount in all maturities, same amount, then we call it parallel downward shift in the yield curve. Parallel upward shifts can be there, or parallel downward shifts can be there. More or less, we assume that in order to simplify our processes, but the reality is not that. So in most of the cases, you observe non-parallel yield curve shifts. Non-parallel yield curve shifts. But in Sri Lanka, what I feel is, in most of the cases, this yield curve shift is somewhat parallel. There won't be much variation in tenors when the rate increases happen or decreases happen. Right. I think now you got my point. What is an yield curve and what is the yield curve shift and all that. Now, if you have a portfolio, then if there's a parallel yield curve shift, if it is immunized, then there won't be any value drop in the total portfolio because the total portfolio duration is 0. So such portfolios are known as immunized portfolios. If you manually do that and find whether the portfolio is immunized, so we call such portfolios immunized portfolios, and that particular function or activity is called portfolio immunization. Portfolio immunization. Any questions? You can ask any question on that. Because what I feel is rather than calculations, you should have some conceptual understandings of these things. Yes, but you can really interact with me on these things. Otherwise, this will become a boring exercise for me and you all. You got the point that it's a parallel shift and all that. What is the meaning, real meaning and all? Now, for example, I just talked on parallel yield curve shift. This is not a very big variation in interest rates, but if you have a shift of a substantial shift in the yield curve, then this immunization cannot be done only with duration. Yeah, you need to get convexity also into consideration, and you need to show that convexity also gets 0. I think you got my point. Now it's like this. If you are referring to a parallel yield curve shift, and the shift is not substantial, very small shift. But if the shift is substantial, in order to do portfolio immunization, you have to look at not only the duration, but convexity also to be, altogether, the total convexity to be 0. So that is the concept you need to understand. Right? I'm referring to portfolio immunization. There are some questions or problems on immunization. Now I want to just show you something else also. Now when we did our calculations on duration and convexity, we went through a bond. But what we can do is we can see how we can calculate the duration of a loan. Duration of a bond is calculation of a duration of a bond we did. But how are we going to calculate the duration of a loan? So how are we going to do it? I think the same principle applies here. Now I will go to the question. Yes. Right. Right. Now if you go to this lesson, at the end of the lesson you have questions. Yeah. Question number 3. Mr. Vijayaratna will be making a car payment of $3,160 per annum for the next 4 years at an interest rate of 10% per annum. What is the duration of the loan? Now, how are we going to do it? Now, though it's a loan, it applies, or it follows the same principle as a bond. Only thing is you have same payment each time. Mr. Vijayaratna will be making a car payment of, now when it is a car payment, for the bank, it's a receipt for the bank. And interest rate is 10%. So they have the, we are only talking about the cash flow, and discounting factor is 10%. Interest rate is 10%. So how are we going to do it? First year your cash flow is 3,160, and what is the present value? 3,160 divided by 1.1. Second year, same cash flow, 3,160 divided by 1.1 to the power 2. Third year, 3,160 divided by 1.1 to the power 3. Fourth year, 3,160 divided by 1.1 to the power 4. Right? Now you can have the things on a worksheet. Now on the time column you have 1, 2, 3, and 4. Then cash flow column you have 3,160 for each year. Then you have the present value. First column you get 3,160 divided by 1.1. Second column, second line you get 3,160 divided by 1.1 to the power 2. Third line you get 3,160 divided by 1.1 to the power 3. Fourth line you get 3,160 divided by 1.1 to the power 4. Now what else we have to do? Now all these present values, when you total it up, you will get a total value. From the total value you can have a weight. Then next column would be the weight column. Then the last column would be time into weight column. So from that you will be in a position to get the duration calculated. Is that okay? So just try it and see whether you can do it. Yes. Are you okay with this? Are you in a position to calculate this, the duration of this? Because the durations can be calculated on loans also. because there's a cash flow. No? Not only loans, you can say if you have a deposit, there also you can calculate the duration. Yes, shall we see how we can do it? Or can you try it off? Question number 3. Yes. Now I like you to do it. The only difference here is you have a same cash flow throughout 4 years at year end. And you can just prepare a worksheet for that. And through the worksheet, you are in a position to calculate the duration. Cash flow, present value, then weight, then time into it. Now, what are the time? 1, 2, 3, 4. Because there are 4 years. Cash flow would be 3,160. Then present value would be 3,160 divided by 1.1. 3,160 divided by 1.1 to the power 2. 3,160 divided by 1.1 to the power 3. 3,160 divided by 1.1 to the power 4. Now these are the present values. So you can do the calculation and see what the present value is. Anyway. You get here 2872.73. Then the second one you get 3,160 divided by 1.1 to the power 2. That is 2,611.57. Then you get 3,160 divided by 1.1 to the power 3. $2,374.15. And the last one, 3,160 divided by 1.1 to the power 4. $2,158.32. Now the PVs are calculated here. 2,872.73 the time first year, second year 2,611.57, Third year 2374.15, fourth year 2158.32. Now you have to get the total of this. Get the total of that. 2872.73 plus 2611.57 plus 2374.15 plus 2158.32 equals 10,016.77. 10,016.77. This is the total value of cash flows, and weights can be found by dividing this one with this one. 2,872.73 divided by 10,000. So that way we can do it. Yeah, you get 0.28679. You can say 0.2868. Next one. Point 2607. Then you get 2374.15 divided by 10,016.77. 0.2370. 2370. The last one, 2158.32 divided by 10,016.77. 0.2155. Now we can just check and see whether these added up to 1. Just see. 0.2868 plus 0.2607 plus 0.2370 0.2370. Point 2155. Yes, it comes to 1. Right. Now what we need to do is we need to multiply the time with the weight. For the first line you get 0.2868. Second line you get 2 into 0.2607. 2 into 0.2607. That is 0.5214. 0.5214. Then 0.2370 into 3. 3 into 0.2370. 0.711. 0.711. The last one. 4 into 0.2155. 0.862. Right. Now when you get the total of this, you arrive at the duration of this loan. You get the answer as 2.3812. 2.3812. So this is the duration. The duration of this loan is 2.3812, even though the loan has a tenor of 4 years. Loan has had a tenor of 4 years, even though it had a 4-year tenor. The duration, when you calculate the duration, you get the duration as only 2.38. 2.38. Now, the reason of having so lower duration, but I think you realized on bonds, when the bond has 3-year maturity, we get the duration as 2.6 something. So then when you compare it with the maturity, the duration is very close. Right? There can be small differences in the, in the decimals, but that's okay. That's okay. Now, when you do it this way, you can see, but since it is a loan, now here the difference is cash flows are similar for any year. Present value would be different. But in a bond scenario, what happens is every cash flow is similar up to the maturity cash flow. Now on the maturity date, you get the whole cash flow of the bond, and that will be a big cash flow. So therefore, for a bond, when you calculate the duration, it is very close to the tenor of the bond. But for a loan, it is not so. Now the tenor of the loan is 4 years here, whereas the duration is only 2.3 something. Now you get the point. So that's another type of phenomenon you need to observe and identify. Is it okay? I think this now it is 10:30. What I suggest is you can do this one using the continuous compounding. So you do the same exercise using the continuous compounding. Now here we have not used the continuous compounding. Here just we use normal compounding. Just do the continuous compounding here and see, get it. So that is your exercise. And now it's 10:30. I will give you a small break of 15 minutes. We will start at 10:45. Right. Thank you very much. We can resume the discussion now. I don't know whether you have tried to attempted to do this on continuous compounded basis. Yeah. There can be small differences, but one person has 10,1973, but as per these valuations, I got 10,1677. Anyway, it doesn't matter, but your value 2.38 would be a value which can be taken as correct. And have you tried it through continuous compounding? So what you need to do is, instead of 3160 divided by 1.1, you can say e to the power 3160 into e to the power minus 0.1 minus 0.1, e to the power minus 0.1. That is the first one. Then the second one, in the second year, you can say 3160 into e to the power minus 2 into 0.1. Third one would be 3160 into e to the power minus 3 into 0.1. Number 4 would be 3160 e to the power minus 4 into 0.1. So these things will come as the continuous compounded basis. So for the interest of you, I will do that on that basis also. I don't know whether it is required. Now, Isiri, have you done it through continuous compounding? 2.374? Yeah, right, correct. Right. I think now you got the point. So therefore, there's no that much of a issue even when you do it through continuous compounding. Only thing is continuous compounding is a very efficient method where we don't need to do these assumptions, because it really goes by continuously compounding this thing. So therefore, there's no big issue on that. So now you will realize that when you talk in terms of asset or a liability, the duration is a measure which you can make on those assets or liabilities depending on the cash flows. So the cash flows will be the most important thing, and the particular applicable interest rate. If you know these two things, you are in a position to calculate duration. Now, I will just give you an example of a particular immunization program. So that one I will really give it as a supplementary problem. Right. Now I will go into another problem, and then we will be in a position to just work it out. Now this is a problem on portfolio immunization. I will put it on the board. Now we are referring to the portfolio immunization. Now, when a portfolio consists of long and short positions in interest rate dependent assets, it can be protected against small parallel shift in the yield curve by ensuring that its duration is zero. Now, this is the concept we are now trying to be familiar with, and we will do a particular problem on this. And I will just explain you a particular problem which consists of pension fund payments made each year of 20 million by a particular company. So that company pays $20 million each year for the pension fund for next 4 years. So for these for payment liability, first of all, you need to calculate the duration. Then, if that company decides to immunize the payments by currently investing in zero coupon bonds with 2-year and 5-year maturities. Now, we have to find out what percent should the particular company allocate to each zero coupon bond. What will be the accumulated face value of the bonds, and assume the yield curve is flat at 11%. Right. Anyway, now we will really work out this problem, and right. Now, just look at a certain problem. I will right. Now, just look at it. A corporation has to make $20 million payment each year for 4 years to its pension fund. So normally the company should fund its pension reserves in order to have it active. So this company also is doing that, and what they do is every year they make a payment to 20 million to that pension fund. Determine the average maturity duration for this 4-year payment. Now there's another thing given. Yield curve is flat at 11%. Yield curve is flat at 11%. What is the meaning of that? Yield curve is flat means for all the 4 years, the yield to maturity or interest rate is 11%. Right. With that information, are you in a position to get the duration calculated for these payments? Just try to calculate it. Now you can have the time periods as 1, 2, 3, 4, cash flows as 2020, 2020. Then you do the needful for calculating the present values, then get the weights and weight into time and get the duration. Yes, can you do that? Right. Now I think you will work with me on this. First of all, you need to have a worksheet. The worksheet is time. There's a time column. There you get 1, 2, 3, 4. Then you have the cash flow column, then the present value column, then the weight column. So just come up with that. Because I am just trying to show you the way it can be immunized. Now I am referring to the $20 payments made by the company for 4 years, and what is our task here is to calculate the duration of those payments. How are we going to do it? So those durations can be taken into consideration. So we can just plot it or just have the worksheet ready. We can say here payment, present value, weight, time into weight. We can say time. 1, 2, 3, 4. Payment is 20, 20, 20, 20. Present value is 20 or 1.11. 20 or 1.11 to the power 2. 20 or 1.11 to the power 3. 20 or 1.11 to the power 4. Now you have to calculate the present values and then the weights. $20 or 1.11 is 18.01, 18.02. 20 over 1.11 to the power 2. 16.23. Then you have 20 over 1.11 to the power 3. 14.62. $20 over 1.11 to the power 4. 13.17. When you take the total, the total is 62.04. Now you can have the weights. The first one you get 0.29, then you get 0.26, then 0.24 and 0.21. It adds up to 1. Then time into weight, we can have 0.29, 0.52, 0.72, 0.84. The total is 2.37. Right. Now you realized the macular duration is 2.37 for these payments. 2.37, yes, good. Right, okay. Now there's another additional thing here. Now after this payments, now the company decides to immunize these payments. Now, if the interest rates change during the season, they will have to face with some issues. So therefore what they decided was, they decided to immunize this portfolio. Now I told, now I just conveyed you that there's a concept called portfolio immunization. What is the principle behind that? Now if you have, now this is a type of a payment you make, but you need to have a receipt of cash to balance this. Now this is a payment you make. Payment in the sense it's a loan payment type of thing, or some payment you make. But you need to, in order to balance this, you have to have an investment. Now what they do is, they invest in 2-year and 5-year coupon bond, zero coupon bonds. So the immunization to happen, you need to have 2 different types of instruments. Now this instrument is a payment instrument, you pay it, but when you have a treasury bill, zero coupon treasury bill or zero coupon bond, the payment will be, you will receive that payment in time to come, right? So therefore, in order to immunize this, these payments, you need to have another receivables for you. Now those receivables are, the decided receivables are 3-year bonds and 2-year bonds. Sorry, 2-year bonds and 5-year bonds, zero coupon bonds with 2-year and 5-year maturities. So I will put that here. I will erase these workings, and we can use the duration what we have calculated, and the duration came as 2.37. So that is the duration what we have calculated. So I will put duration as 2.37. So for the time being, I will erase these workings. Company decided to immunize the payments by investing in 2-year and 5-year zero coupon bonds. zero coupon bonds. Then you need to find the what percentage should the company allocate to each bond. So this is the thing. Now, why I have just put it this way, because I want to just give you the real process. Now the company has a payment to be made for the coming 4 years. That payment is made for their pension fund. We all know the payment is $20 million for each year, and the duration we have already calculated, that is 2.37. But now the company's financial analyst, now they decided to immunize this portfolio, immunize these payments. Now why they are going to immunize? Because sometimes if the interest rates go up, the present value of these payments will be very low. So therefore, what they want to do is they want to immunize the payments. In order to immunize the payments, they decided to invest in two types of zero coupon bonds. What are these two types of bonds? 2-year bonds in one side, the other one is 5-year bonds. Now, I am asking you a question here. When you have a 2-year zero coupon bond, what is the duration of that bond? What is the duration of that bond? Yes? Two years exactly. Very good. Very good. And in the 5-year bond also, 5-year bond, if you take a 5-year bond, exactly the duration of that 5-year zero coupon bond is 5 years. I think now you know that. Now what we need to do here is, we need to select a portion or percentage of 2-year and 5-year bonds. For example, if I select 20% of 2-year bonds, and then we have to select 80% of 5-year bonds, that way. So then we assume our selection of 2-year bonds is X, percentage is X. Then invariably 5-year bonds would be 1 minus X. Right? Now, in order to immunize the portfolio, what should happen? The mix of these 2-year and 5-year bonds duration should be equal to 2.37. So that is what you mean by immunization. In other words, 2.37 is a minus duration. Why it is so? Because it's a payment you are going to make every year. But this 2-year and 5-year bonds you are going to receive. So therefore, the duration of that would be positive. Then what should happen? Duration of the both bonds minus 2.37 should be 0. In other words, the percentage of 2-year bonds into 2 plus percentage of 5-year bonds into 5 should be equal to 2.37. Right? So then what we can do here is, we can find out what is the percentage of 2-year bonds and what is the percentage of 5-year bonds should be in the portfolio in order to immunize the portfolio. In order to immunize the portfolio, right? So for that, we need to have an assumption. We assume we have X percentage of 2-year bonds, right? That is the assumption. Now I will work it out. Assume that percentage of 2-year bonds as X. Therefore, percentage of 5-year bonds equal to 1 minus X. 1 minus X. A percentage means now we can put it in decimal form. If it is 20%, we can say it is 0.2. Now, since it is 0.2, what is the other one? Then 0.8. So that is how it comes. So anyway, now we are trying to calculate what it is. Now, what I can tell you is, now for a 2-year bond, the duration is 2. So therefore, in order to calculate the weighted duration, what we do? We have to multiply the percentage with the duration, or weight with the duration. 2 into X plus 5 into 1 minus X. That will give the duration of portfolio of 2-year and 5-year zero coupon bonds. It should be equal to 2.37, right? In order to immunize. And we say, in order to immunize the payments, 2 into X plus 5 into 1 pi minus X should be equal to 2.37. Now this is an equation which we can form, and we will be in a position to find out the value of X by solving this equation. Now you try to solve that equation. Yeah, 2-year bond percentage is 87.76. Yes. Yes. I think what we can do is, since it gives us a correct. Since it gives us a certain, it's little cumbersome to have this 0.66, and also therefore we just take it as 88% and 12%. 88% and 12%, right? So that is a better way. It's okay. 88 and say the two bonds will be mixed in that percentage. You need to get 88% of 2-year bond. I put it as a approximated value rather than talking in terms of 87.66, but you can put it as 88. But then we say, in order to immunize the portfolio, we should get 88% of 2-year bonds and 12% of 5-year bonds. If you have such a portfolio, it will be an immunized one. So you don't get any effect through any type of interest rate variation. So that is what you mean by immunization, right? Very good. Now your workings are okay. You did the good workings, and only thing is we can put it into an approximated level. So you can say 88% of 2-year and 12% of 5-year bonds. Then further, we need to do something else also. And now the next issue is, what will be the face value of the bonds, accumulated face value of the bonds. What will be the accumulated face value of the bonds? Now, how are we going to just get it? Now, we are trying to get the face value. Yes. Now, the question is, what will be the accumulated face value of the bonds? So, in order to get the accumulated face value of the bonds, we need to get the face value of each bond. Now, are we in a position to get the market value of bonds? How are we going to get it? Now, what is the total payments present value? We got the calculation, no? Total payments present value, I got the calculation. I said it is 62.04, no? As per the calculations. Got my point. Now, we are going to have 4-year payments. Present value of which will be 62.04. That we calculated, no? 62.04. Now a question is asked, what is the face value of total bonds? What they ask is that. What is the face value of total bonds? Now, how are we going to do it? Now, as it is, we calculated in the portfolio 2-year bonds. What is the weight of 2-year bonds? They have 88% of 2-year bonds, 12% of 5-year bonds. Right? Now, the total market value should be equal to that value, that percent value of the 4 payments. So that is 62.04. So what is the market value of 2-year bonds then? 0.88 into 62.04. That is the market value or the present value. Sorry, it's the present value. It's the present value of 2-year bonds, because the 2-year bonds contributes 88% to the portfolio. The total portfolio's value would be 62.04. Therefore, the market value of 2-year bond would be 0.88 into 62.04. 0.88 into 68.00. 62.04. Then the other one, 0.12 into 62.04. So those values we can calculate, and it comes to, for 2-year bonds, the market value is 54.6. Market value is 54.6. That is for the 2-year bonds. And 5-year bonds, the market value is 7.44. I think you got the point. What we did was, we just approximated the percentages, as 2-year bonds as 88%, 5-year bonds as 12%. So when you have that, and the total market value is 62.04, and you can get the market value of 2-year bonds as 62.04 into 0.88. Then that is 54.6. That is the market value of 2-year bonds, 54.6. 2-year bonds. What is the market value of 5-year bonds? 62.04 into 0.12. That comes to 7.44. Right? Those are the market values. We can write it down somewhere. MV of 2-year bonds. That is 62.04 into 0.88. That comes to 54.6. And 5-year bonds. 5-year bonds. 62.04 into 0.12. That comes to 7.44. These are the market values. But what the question asked is, you have to find out the face value of these bonds. Face value. Now, how are we going to get the face value through the market value? Now, this bond is a 2-year bond. One bond is a 2-year bond. Its market value is 54.6. And how are we going to get the face value? The yield curve is 0.1 or 0.11. The yield is 0.11. So therefore, the face value would be 54.6 into 1.11 to the power 2. 54.6 into 1.11 to the power 2. That is the face value of 2-year bonds. Get the value for that. Calculate the value for that. That will become, so 54.6 into 1.11 to the power 2, because it is a 2-year one. $66.06. Is that correct? 54.6 into 1.11 to the power 2. 1.11 to the power 2. Yeah, the answer would be 67.27. 67.27. Yeah, 67.27 is the value for 2-year bonds. Then the other one is other one is 7.44 into the other one. 7.44 into how much? 1.11 to the power 5, because it's a 5-year bond. Since it's a 5-year bond, it has to be 1.11 to the power 5. So that comes to 12.54. Correct, very correct. 67.27 and 12.54 will be the face value of these two bonds. So therefore, the total bond portfolio's face value will be 67.27 plus 12.54. 67.27 plus 12.54. That comes to 79.81. So that is the face value of the bonds which the company purchased in order to have this immunization. Okay, now this gives you a certain idea, certain practical idea about the portfolio immunization. Now that Chenali's answer is correct, and it is 67.27 for the 2-year bond, the face value, and 12.54 for the 5-year bond. Now, on the face of it, you will see the amounts or the percentages of 5-year bond is less here. What is the why it is the why the reason? Because our total duration is limited to 2.37. So in a 2.37 duration, to get as the weighted duration, you need to have a substantially high amount in 2-year bonds there. 5-year bond should be very less amount you should have. 66.6. No, if you have apply the value as 0.8, the value as, I think, I don't know whether you have taken 87.66 as the percentage, but what I suggest was I asked you to get percentage as 88% and 12%, rather than going for these things. Anyway, if you have taken that way, then your answer would be correct sometimes. It's okay. So, yeah. No, your answers are correct. All answers are correct, except this 66.6. I think you might have gone through the 87.66 and 12.34 measures. So if you applied those things, then they would have got that. Anyway, I think you might have understood the things. And you can make use of this immunization for any other positions also. So, any questions on this? Because there are some physical implications here. So those implications are very much important for you to apply in your day-to-day analytical functions, or sometimes you have to manage portfolios, you have to manage your payments, receipts, and all that. So if you are in that type of position, or if you are in an investment committee or somewhere, so you can have a good idea about your bond portfolios, how the bond portfolios really give a return and all that. So for all these things, you need this analytical competencies. Okay, now I just ask you anything regarding these things. You can ask any questions, or if you don't have any idea about these things, or any physical idea, so you can ask me how these things can come in practical terms. No, irrespective of your answer, whether it is correct or wrong. So that's a very positive, I think I really appreciate your attempts and all. So without that, without the engagement, without the involvement, without your active involvement, the success will be very far if you don't have that type of an involvement. So the involvement is more important here, and you have to be with the class, and when you do some calculations, you have to follow the calculations and do it as it is on your own. And later, if you can do again on your own the calculations, then that will be registered in your mind. So that is how the learning is possible. Okay. So I think now you have been able to understand the reality of portfolio immunization. Yes. Now there are also some limitations are there. Now just see, when large parallel shift in the yield curve are present, the portfolio can be protected by ensuring that the duration and convexity are both 0. Now we will see. Now here we have taken into consideration only the duration, not the convexity. We have not taken into consideration the convexity. But if the yield curve shift is substantial, it is not a small or small type of yield curve shift. If it is a substantial yield curve shift, then we have to, in order to immunize the portfolio, we have to look at not only the duration, but the convexity also. Right. Now, any questions? I just prepare to answer your questions on this immunization, because it's a new thinking and not a very new one, but for normal people or people who are in the normal banking stream, I don't think that you have that type of exposure for this immunization methods or whatever. But it's a type of modern analytical thinking. So therefore, I need to get your feedback on this, and I suppose that you are in a position to work out problems on these principles. And if you have any doubt or any type of confusion, you can ask any question now. So if possible, I will try to clear your doubts or whatever. Right. I think we learned very important type of concepts in today's lecture or today's presentation. The limitations of duration and how we can make use of convexity in order to mitigate those limitations. And we talked about the immunization, portfolio immunization and all that. Right. Now I will just give you a small exercise. Now I am asking you, have you thoroughly understood the things here? Yes. I can see your names here, so you can just engage in the discussion or whatever, because I need a feedback from you. Yes. Now it seems that you are not going to really, interact. So I think the interaction is very important for this type of things. Anyhow, I will just give you another type of exercise where you can I just want to see whether even a few number of people can work this type of things out. Anyway, now I will just put you onto the presentation. Right. Now here you have this portfolio immunization this thing, but right. Then we need to talk in terms of non-parallel yield curve shifts. Non-parallel yield curve shifts. What do you mean by that? Now, in reality, parallel yield curve shifts are very, very rare. But non-parallel yield curve shifts are more frequent than parallel yield curve shifts. So as it is, on the face of it, what the meaning is, in different maturities, when yields are changing, for different maturities, it changes in different way. For example, 6 months treasury bills interest rate is increased by say 1%, but 12 months treasury bills interest rate might increase by 1.2, not 1%. So likewise, there can be different interest rate changes for different maturities. If that is the case, we call it non-parallel yield curve shift. Non-parallel yield curve shift. Now, up to now we did different calculations. All the calculations were based on the assumption the yield curve shift is a parallel one. And basically at the initial stages, what we did was there was another assumption. The yield curve shift is a very, very small shift, and it is parallel also. All these assumptions were there when we did our initial calculations on duration and all. But even when we do the convexity adjustment, that is that really address the volume or the range of interest rate change. Now, convexity adjustment is made only for the large shifts, but still our assumption was the yield curve shift is parallel. So therefore, the convexity also will not be in a position to deal with non-parallel yield curve shifts. But there are two methods where you can apply to arrive at the sensitivities of non-parallel yield curve shifts by following partial duration. That is one type of partial duration is a subject area, and there's another thing called principal component analysis. Now, both of these concepts we are not going to discuss. That is not under our purview, so it is beyond our span of things. So therefore, we are not going to talk on these partial duration and principal component analysis. Because this principal component analysis should have a particular mathematical knowledge where we have to really deal with metrics and all that. But anyway, I think the things which we have already learned would give us support in our analytical work. That is the real or actual reason or actual purpose of doing these things is that. So in analytical terms, these things are very helpful. Right. Now you have an exercise now on portfolio immunization, and this is another possible problem which you might get in your examination. So I will read it for you. A company makes payment of $40 to a reserve fund on an annual basis for 5 years. They need to immunize these payments by investing into 3-year and 5-year zero coupon bonds. YTM is 12%. Number one, what is the macular duration of the payments? Number two, find out the percentage of 3-year and 5-year bonds. Calculate the face value of the bonds. So these are the questions. Now you need to do it yourself. Just start with doing it, and the first answer should be the duration. Duration will be the first answer. So you do it and try your best to do it on your own. Yes. Have anyone got answer for the macular duration? Yeah. Yeah, correct. 2.77 is correct. Very good. Very good. Right. Now, how are we going to arrive at the next answer? That is the face value of, percentage of 3 and 5 year bonds. So that you need to calculate. Face value of 3 and 5 year bonds. Just make a small change here. Not 3 year, it should be 2 year. You can say 2 year. So sorry for that. So just put 2 years. Not 3 years, huh? Here 2 years. Now I made a small change there. So the bonds would be not the 3-year and 5-year bonds. Those are 2-year and 5-year bonds, not 3 and 5-year bonds. Right, now just check what is the percentage of 2-year bonds and what is the percentage of 5-year bonds in the portfolio in order to immunize. So you can have a approximation for that. So as Dulcinda said, it should be, or even Saumya, 74% and 26%. That can be taken as the answer. So it is correct that even if you put 74.24 and 25.76 also okay, but in order to have a simplistic way, so we can put it as 74% and 26%. So then just get, I think now you got the point clearly now. So the next one. So how are we going to calculate the next one? The face value of the bonds. In order to do that, you need to have the total present value of the cash flows which the company has paid. Is that 106.68? You have given the total, no? Yes, 144.19 into 0.74. 106.67. Yes. Here, Shanali's answer is correct. 199.89. Yes, that answer is correct, because you will get the market value as 106.7 for the 2-year bond, and 5-year bond market value 37.49, and then when you multiply 106.70 with 1.12 to the power 2, so you might get 133.84, and 37.49 1.112 to the power 5, so that comes to 66.707. So the total would be 199.89. or even sometimes now my answer, I got my answer as 199.91 anyway, no issue. If there's a small decimal change, there's no issue, because that can come with the approximation errors. So therefore, I don't think that it would be a problem. So anyway, now I am really happy that even some of you can just tackle this type of a question. And as I told you earlier, the questions we discussed today are very much important. And the first one we discussed with regard to this convexity and duration has a great, there's a possibility of coming into the examination, or even this particular one also, immunization. because since it is a modern type of theoretical base, the immunization. So therefore, you should expect this type of questions in your question paper, even a part of a question sometimes. Anyway, now from next time onwards, I will try to discuss the past question papers. Now we have already completed capital asset pricing model, risk returns, then capital market theory, efficient frontiers, then bond valuations, accrued interest, dirty price, clean price, then duration, convexity, immunization, portfolio strategies, and all sort of things. Parallel yield curve shift, and such type of things. And I think there are some other things to be covered, and those things will be the performance evaluation of companies and all that. So those things we will try to do in next couple of weeks. And during the sessions, I will try to discuss the past question papers also. So therefore, I think you should get that type of exposures, because just to listen to lectures or just to look at these things, even I know that some of you sometimes might go only into the recordings or whatever. So that is okay if you have a urgent matter and all that, then you can do that, but don't do it every day. If nothing else can be done, only you should do that. So therefore, it is better if you can. The best way is to you come to the you just join in the discussion in an active manner. Then you are in a position to gain gain efficiently all the things, and that would really help you to enhance your knowledge and attitudinal type of things and all sort of things. All the competencies you can really enhance by doing that. Anyway, now I really look into your feedback, which is very much rare and very much few and far between. So anyway, anything we can really discuss, or now another 5 to 10 minutes is there, so you can just ask any type of question. I think last time some 2 or 3 participants really asked questions, and that was a good thing. And I from the beginning there were some questions in one session, I can remember. So I think that type of liveliness should have to be maintained. So if you can do that, that is a good thing for every participant. So anyway, at the last moment, anything can be cleared. So you can ask any question. Yeah.
At the last question, sir, the total face value of the bond is 199.89 now. Then in that, when we aggregate in the cash flows, it is getting 200. Are there any connection between that cash flow and this face value?
When you yeah, of course. But only thing is now rather what happens is now you had $40 cash flows. I think that's a good observation. That's a good observation. But what happens is now when you say now all the cash flows are similar, but there should be, it is not really, I mean it may not come to it is 199.89. Yeah, I think you have a point, but why it happens is now you just took the things in present value terms. When you get the present value terms, yeah. Now, really, the 199.89 is really the really your outflow. Your outflow, that is not the present value, that is the total outflow. No, so that's what you say.
Yeah.
It is really equal, very close to the face value of the bond. That's what you say, no? It is very close to the face value of the bond. No, right. I think that's correct. That's correct, because now when you make your payments, those payments will have a say. Now you put only 40 million per year, no? So then when you add it up, you get it as 200. So that is the face, no? That is on the face of it, no? So there won't be any change in that. So therefore, I think your indication or your observation is really valid. It is really valid. Earlier one, have you seen that?
Yes. In earlier one also, sir,
It is
the
close to 80,
total
no?
face value is 79.81 and cash flow
Right.
is 80.
I think that your observation is correct. That's correct. That's correct, because it should be equal to that. What I feel is it should be equal, because it's a face value we are talking about, no? There's no difference in the face value, no? Now, say for example, if you whatever it is, on the face value, it is same, no? Now the matter happens only when we take it into a market value and present value, no? But if you take the face value as it is, then there won't be any change. So I think that observation is a great observation. I think that's good. So, but your suggestion is correct, because it should be equal. But this is some calculation, rounding off errors and all. That's otherwise it should be 200. It should become 200. So I really appreciate your observation. Yes. Anything else? Now I really ask you. I am asking you now. The things which we discuss, are they clear? Are they clear enough? Yes. And the other thing, the very important thing is, now you should be in a position to work out these sums on your own. That is a check you can make on this, whether you understood these things or not. That can be gauged through when you can work out any sums or whatever on your own. So that is the type of test you can make. Yes. Anything else? From next time onwards, we try to discuss the question papers also. But what I feel is, now I feel very it's very far from satisfactory, the responses. That is the issue. So I don't know, now there are about 38 to 40 people here, but whether the things been really understood, so that we don't know. That is the issue. Anyway, if we can just give some quizzes or something like that, I can just gauge your understanding or whatever. But that is also very little difficult for us to do. Anyway, right. So you prepare for your things, and you can just go through the things again, and or even the presentations. So then, if you come across any type of confusion or any problem, let me know. Let us discuss those things in the next sessions. So thank you very much for your active participation, and I think you all can now step into a analytical field where you can really derive so much of benefits. And thank you very much.
Hello.
Yes.
Hello, sir. Good afternoon, sir.
Yes. Anyway, you can talk. Yes.
In previous questions,
Yeah.
you put the figures in weighted column, weight column.
Yeah.
How to got that figures? I don't explain. I can't explain that.
You couldn't write it. You can take it down. Right.
Weight,
So no. Wait. Yeah. Weight is really taken by this way. Now you just calculate the present values now. Present value of cash
yes.
flows now. Now all
Yes,
these
yes.
present values you have to divide by the total present value. Now by doing that you get the weight.
Total present value divided by
You have to
total.
divide it by the total present value. So then you get the weight.
Okay.
Right.
Thank you. Okay.